this is Dr. Patty Hatfield, and I'm here to talk to you about capital budgeting techniques. What I plan to do is talk to you about the 5 most commonly used techniques, but I do want to emphasize that this by no means is an exhaustive list of the capital budgeting techniques out there, but it gives you a flavor of some of the more popular ones. And so in terms of the objective of the course, we're going to conduct investment analysis and provide recommendations on capital investments. So that's what we're working toward here. This is part 1 of the capital budgeting series. The second one talks about capital budgeting theory, which is very important and should go along with this video. So as I demonstrate each of the capital budgeting techniques, I'm going to use these 4 projects. And let's assume that these projects are mutually exclusive, meaning that you're going to choose the one project that is optimal. Okay, and by optimal, we mean maximizes the value of the firm. So notice at time period 0 or year 0, that's when we would invest. That represents today. And each of the projects cost $1,000. And with the parentheses around it, that's showing you it's a cash outflow. So projects A, B, and C and D each cost $1,000, and in return, for example, project A, you'll get $100 back at the end of year 1. Cash flows are assumed to occur at the end of each year for most of these techniques. For project A at the end of year 2, it'd be $900, project 3 $100, and then notice how you lose money in years 4 and 5 with project A with a negative $100 and negative $400 for years 4 and 5 respectively. Also notice that all these projects have the same life. They all have a 5-year life. So in other words, we don't have any complicating factors here. It's a really straightforward, easy calculation to make to determine which of these would be the best. Another thing I'd like to point out is notice with project B, we have what we call deferred cash flows. In other words, you're not receiving anything in years 1 and 2, and then you receive some money in years 3, 4, and then a big chunk in year 5. So the projects are assumed to be of equal risk. So right now we're going to assume risk out of the equation too. We just want to evaluate cash flows, and then we'll build on this and add risk and different lives of projects later on. So the first method I'm going to introduce is the payback method. And that one's pretty obvious even by the name. The payback is basically whichever project returns your initial investment the fastest, that's the project that you would choose if you were to use the payback method to make investment decisions. This is the only capital budgeting technique that we'll be talking about that assumes that cash flows occur evenly throughout the year. So that way you can have 2.5 years or 2 1/3 years, whatever, you can have partial years to get your investment back. I can already tell you that there are a number of problems with the payback, and actually I guess we'll go through those in a minute, but let's go ahead and calculate the payback for each one of our projects that I just showed you earlier. So here are the 4 projects, and you can see with project A cost $1,000, and if you look, we'll get 100 of it back in year 1 and 900 back in year 2. So by the end of year 2, we will have received the $1,000 back. So the payback for project A is 2 years. Okay, and if you do the same calculation for project B, you'll see we get nothing in years 1 and 2. We get $300 in year 3, another $700 in year 4. So by the end of year 4, we receive our $1,000 investment. Okay, and then we just keep doing that for project C and D. And so you see for project C, it takes us also 4 years to get our money back. And then for project D, it takes us 3 years before we get our $1,000 back. So here are the results. Okay, we get project A, 2 years like we said, project B 4, C 4, and D 3. So if we were to use the payback as a means of determining the best project, it would say you should go with Project A. Now let's say that you were given the task of finding the best project between these 4 projects. Okay, so being the overachiever that you are, you're going to be extra careful, and you're going to go ahead and calculate all the capital budgeting techniques that you're aware of, or the major ones anyway, and determine which is the best. So right now you just finished the payback, which is highly popular, by the way. If you look at surveys, over 90% of firms out there use payback. I mean, like close to 90, well, depending on the survey, 95 to 99%. As you might guess, since that number is so high, most firms, if not all major corporations, use what we call multiple evaluation techniques. So they'll use more than one technique to make investment decisions. So, okay, so we have so many firms using the payback to help make decisions. What's wrong with that? You know, what's wrong with the payback? Well, let's look at some problems. The first problem with the payback method is that it does not consider the time value of money. So I have the same Project A here, which costs $1,000 and gives us 100 in year 1 and 900 in year 2. And now I made up a different Project B, which costs $1,000, and I flipped it, where it gives us $900 in year 1 and $100 in year 2. Notice if we were using the payback method, you would be indifferent between those 2 projects because they both have a payback of 2 years. So you really wouldn't care whether you invested in Project A or Project B. But, you know, if we want to add a little bit more drama to the example, you know, add 6 zeros, or at least 3 zeros to the end of all those numbers. And you tell me which project you'd rather invest in. And of course the answer is Project B, because we'll add 3 zeros. If you get $900,000 back at the end of the first year, as opposed to waiting till the end of the second year, you would have $900,000 that you could reinvest and earn some return on. So of course time value of money matters. So payback method does not consider the time value of money. Now, having said that, there is such a thing as the discounted payback method, which does take into consideration the time value of money, and you just discount the cash flows by the firm's cost of capital, which I'll talk about more later. So it would do away with this problem. However, there's another problem with the payback that even the discounted cash flow payback does not take into consideration. And that is that the payback does not consider cash flows beyond the payback period. So again, looking at my Project A and my new made up Project B, notice here the payback between the 2 is 2 years, so I'm indifferent between the 2. Let's say that I recognize the time value of money, you know, here, then again with the discounted payback you would go with Project B. But notice that it doesn't consider any of the cash flows beyond that 2-year period. So for example, if this $1,000 in year 3 and this $1,000 in year 4 would happen to be negative, okay, you would still prefer then your payback would be indifferent between the 2, but in reality you'd lose more money with Project B than you would with Project A. So the fact that it doesn't consider any possible negative cash flows or any positive cash flows after that payback period is a real problem. So we're going to throw the payback method out right away in terms of that is not a good method to use for decision making. The next one is the simple rate of return, and also called the accounting rate of return. And let me mention that it even has other names besides that, and there's a number of variations on this formula. So I used what is a pretty popular form of the formula, and again, I'll just call it the simple rate of return. That's what I've got there for the acronym. This is the only one of the capital budgeting techniques that we'll be taking a look at that actually looks at the accounting profit after taxes instead of cash flow. Okay, so even the payback was looking at the cash flow associated with the project. Now we're going to be looking at accounting profit. So that's really the first problem, because we know from earlier classes that accounting profits are not equal to cash flow. Okay, because you have a lot of non-cash expenses being accounted for in your accounting profits, like depreciation and amortization. So you do not want to use accounting profits when you're trying to evaluate a project. You need to know how much cash is being generated, and then you need to evaluate the cash, because the cash is what determines value. So, but because this is a popular technique, let's take a look at it. On this next slide, I talk about the disadvantages, which I just talked about a second ago. So here's our four projects, and again, same four that we started out with. And so let's assume, instead of cash flows, that these are accounting profits. Okay? So what you'll want to do is sum up the accounting profits and divide by 5 years to get an average accounting profit. Okay? So again, we're assuming that these are accounting profits rather than cash flows. So for the simple rate of return, for Project A, for example, remember we had $100 in year 1 for Project A, $900 in year 2, $100 in year 3, and then negative $100 and $400 in years 4 and 5. So when you sum that up and divide by 5, our average profit is $120. Divide that by our initial investment, and like I said, some formulas vary from that. Some would be the average investment, so it might be initial investment divided by 2. But here we've got 12% as our simple rate of return. So what if we go ahead and do that for all the projects? This is the simple rate of return for Project B. Okay, the average profit is $460 divided by the $1,000 net investment. So it's 46%. For Project C, it's 45%, and for Project D, it's 42%. So you went forward and calculated the simple rate of return, and based on your results, you would go with Project B. Okay, like I mentioned earlier, there's problems with simple rate of return. We already talked about the first one, that it uses accounting income rather than cash flows. What I didn't talk about is it fails to discount cash flows. So again, it's not taking into account financing, the cost of financing, or the time value of money. And then third, it ignores the economic life and the terminal cash flows. And I hit that pretty hard in part 2 of this video. So since that requires some build up, I'm going to leave that explanation for the second video. All right, the third capital budgeting technique is the net present value. The net present value is equal to the present value of your cash inflows, in this case I have cash flows, minus the initial investment. And so you're discounting the cash flows by the firm's cost of capital. So the cost of capital is the average cost of financing for the firm. So as we know, firms finance their projects usually through bond issuances, probably stock, it could be stock issuances, retained earnings, which requires a rate of return. I've got another video that talks about sources of financing and the pros and cons of each one. Possibly bank loans, but that's not used very often at all. But what you have to do is come up with the average overall cost of financing for the firm, and we refer to that as the cost of capital. Well, if you remember, in the cash flows, we don't have anywhere in the cash flows where we account for the cost of financing. So if you go back and look at my cash flow estimation video, you'll see that we consider all the expenses associated with the project except for cost of financing. So this is where cost of financing comes in. It comes in through the discount rate. So the net present value is found by taking the present value of the cash inflows that you expect to receive from the project minus the initial investment. The idea is if the net present value is greater than or equal to 0, then you could accept the project. In other words, it's going to add value to the firm. And another way of interpreting that is it's going to cover not only all of the expenses associated with the project, but also the cost of financing. Now, if net present value is exactly 0, that means you're just covering everything, including the cost of financing. To be honest, in practice, you would not accept a project that had an NPV of 0 unless you had no choice. You know, sometimes you're forced to do projects that you don't necessarily want to do just to stay in business. So this is in theory. In theory, if the NPV is 0, then you could still accept, but you know, again, in practice, the higher the NPV, the better. If the net present value is less than 0, then you would hope to reject it. And again, I say hope to reject it because, you know, if there's some sort of regulation that you're required to comply with, it may require a negative net present value investment in order to comply. So we can't always reject all the projects we want to, but obviously the majority of projects that we invest in have to have positive NPVs. So how do we calculate the net present value? Well, let me go ahead and do the one for Project A and show you that one. So remember, here's the cash flows again. So for Project A, we have a $1,000 initial investment followed by the 3 positive cash flows and the 2 negative cash flows. And now I'm going to assume that the cost of capital is 10%. So I'm going to have to use my present value interest factor table at 10% to get my present value interest factors. Now I'm going to show you how to calculate this by hand in the next slide, but you won't be doing that. You'll be using Excel and the Excel functions to calculate net present value and internal rate of return and some of these others that we'll be talking about. But I like to still demonstrate exactly how it's calculated by hand so you can see what's going on behind the Excel spreadsheet so that it makes sense. And it'll also help the theory, part 2. If you know how it's calculated, then understanding the theory behind these techniques becomes a lot easier. Okay, so here's the net present value for Project A as promised. So here's the present value of cash flows. So our cash flows was $100 in year 1, and I got that interest factor of 0.909 from the present value table, looking at the 10% column down 1 period because that cash flow occurs in year 1. The second cash flow that occurs in year 2 has a discount present value interest factor of 0.826, and then so on. In year 3, 0.751. In year 4, notice the negative sign there. With net present value, you can carry the positive or the negative cash flow. So it's a negative cash flow of $100 with a present value interest factor of 0.683, and then another negative cash flow in year 5 with the present value interest factor of 0.621. So when you sum up the present value of all the cash flows you expect to receive from the project, it comes out to $592.70. So according to our formula, we take the present value of the cash inflows, which is $592.70, minus my initial investment, and I have a negative NPV of $407.30. So again, since it's below 0, if we can reject the project, we would prefer to reject it. In this case, since we have 4 projects that we're deciding between, we'll calculate the NPVs for all of them. I won't show all the calculations. I'll give you the end results, and if you want to try it on your own, you can. But the NPV results look like this. So the net present value for Project B, again discounting at 10%, is $510.70. For Project C, $530.85. For Project D, $519.20. So based on the results of the net present value, you'd want to go with the one with the highest NPV, which is Project C, $530.85. The next capital budgeting technique we want to take a look at is the internal rate of return. And I have the formula there for the internal rate of return, and it's very similar to the formula. If you were to look at the formula for the net present value, you would see that it's very similar, the difference being that the cash flows that you receive each year are actually being discounted by the internal rate of return rather than the firm's cost of capital. Okay, that's the difference. So with NPV, you've got your cash flows each year and they're being discounted by the firm's cost of capital, and then subtract your initial investment, and that gives you an NPV. For the internal rate of return, you're taking each of your cash flows and discounting it by the internal rate of return. Subtract your initial investment, and you want that to equal 0. So you're looking for, ultimately it's a trial and error process where you're looking for the discount rate that will allow you to have an NPV of 0. And that, in essence, is the yield of the project. So you've heard of a yield to maturity on a bond. Well, that's what the internal rate of return is to a project. It's the yield to maturity of a project. Okay, it tells you what rate of return you would earn on the project. So if the internal rate of return, if your yield on the project is greater than what it's going to cost you to finance the project, then the project would be acceptable. If the internal rate of return is less than what it would cost you to finance the project, then you would reject it. All right, so let's go through, this time we'll go through Project B, and I'll show you kind of the trial and error approach. Again, just so you can see what goes on behind the Excel spreadsheet, because in Excel there is an internal rate of return function that we can use, but this will help us know what's going on. Okay, so Project B, there you see my cash flows there. I have my $1,000 initial investment followed by 0 and 0 in years 1 and 2, $300 in year 3, $700 in year 4, and then $1,300 in year 5. Okay, so trial and error. So I just have to pick a discount rate that I think will give me an NPV of 0. So I just picked something out of thin air and I tried 20%. So since I don't have cash flows the first 2 years, there's nothing to discount. And of course, time period 0 is already in today's terms, so you don't discount that. It's already discounted. So we just have to discount the cash flows in years 3, 4, and 5. So if I go to my present value table and look at 20% for 3 years, I'll see it's 0.579, 4 years 0.482, 5 years 0.402. When I multiply and get my present values, this is what I come up with over here in that last column, present value cash flows. And then when I subtract my $1,000 initial investment up top, I end up with a net present value at 20% equal to $33.70. So I'm very close to 0, but I'm not quite there. So 20% is not the internal rate of return on this project. So I need that NPV to go down to 0, which means then I'm going to have to increase my discount rate. So I go ahead and increase my discount rate, let's say to 21%, and try and see what happens. Okay, so when I move it to 21% and go through that same process, you'll see that I came really close to 0. So now I have an NPV of negative $2.10. So, practically if you wanted to estimate, it's going to be really close to, your internal rate of return is going to be really close to 21%. You can interpolate and you'll get 20.9%. And of course, since you're not going to be doing it this way and you're going to be doing it through Excel, Excel will give you the 20.9%. But this is what's going on behind the Excel calculations. It is going through to figure out what rate of return causes this project to have an NPV of 0. And here we see it's 20.9%. So let's take a look at all our IRRs and compare them. So the IRR for Project A is 200% negative, okay? For Project B, it's 20.9%, which we just found. For Project C, it's 22.8%, and for Project D, it's 25.4%. So based on the internal rate of returns, we would choose Project D at 25.4% since it's the highest one. And again, this is the, like if you think of if you were to purchase the project and hold it to the end of its economic life, this is the rate of return. This is the yield to maturity on the project. So you would compare the internal rate of return to the cost of capital. Since our cost of capital is 10%, all of them make the cut except for Project A. And then D has the highest, so we go with D. The last capital budgeting technique we'll take a look at is the Profitability Index. And the Profitability Index, as you notice, is very, very similar to the NPV in that it has you discount the cash flows from the project exactly like we did with the NPV, but instead of subtracting the initial investment from the present value of the cash flows, we're going to divide the initial investment, or divide the present value of the cash flows by the initial investment, okay? So that's the only difference. Other than that, the calculation is the same as NPV. So rather than subtracting net investment, we divide. So the idea is if your benefits, which is in the numerator, present value of the cash flows, are greater than your cost, then the project's acceptable. So in other words, if the profitability index is greater than 1 or equal to 1 in theory, the project is acceptable. If the profitability index is less than 1, then you would reject it. And like the NPV, we are discounting by the cost of capital. So it's the cost of financing that's getting considered in this process. So let's go ahead and just go back to our calculations that we had already done for Project A when we calculated the NPV. If you remember, when we calculated the present value of the cash flows for Project A, we came out with a total present value of cash flows of $592.70. So let's just go ahead and use that, and we put that in our numerator, and then we divide that by the $1,000 net investment, and we get 0.5927, which gives us a profitability index of less than 1. Okay, so again, if we could reject that project, that would be one we'd like to reject, because the way we interpret this is that for every dollar invested, we're getting back 59 cents. Okay, and that's obviously not a good deal. But sometimes we have no choice but to take those types of projects on. Let's look at the profitability index for all the other projects. Okay, for Project B, it's $1.51. So for every dollar invested, we're going to get back $1.51. For Project C, it's $1.53, and for Project D, it's $1.52. So you can see it's really tight. Really tight there. So between all of them, the one that we would choose is the one with the highest profitability index, and that would be Project C. I tried really hard to get a Project E to come out mathematically and work for us, but it didn't work out that way. So profitability index agrees with NPV about Project C. By the way, that's not always the case, and I'll explain why later. Okay, so again, you were given the task of choosing the best project, and so you were being very meticulous, and you applied all these capital budgeting techniques that you knew about, And here's the summary of your results. The payback tells us we should go with Project A. The simple rate of return says we should go with Project B. Net present value says we should go with Project C. Internal rate of return, Project D. And then Profitability Index, Project C. So now what do you do? We already talked about the downsides of payback. Okay, so by the way, if payback is so bad, why do people use it? Why is it used by like 90-something% of the firms? Most firms don't use it for decision making. They might use it to weed out some projects, but still, that's not payback isn't a good use for that either, because what it's going to do is it's going to cause you to invest in more short-term projects, and sometimes your most valuable strategic projects are long-term. So, it's going to bias you toward these short-term projects. So payback is just not a good method. Simple rate of return, we already talked about, is not a good method. And again, that's because it uses accounting profit. It's not a good method in the sense that, okay, this is what we're going to use to make a capital budgeting decision. However, if you just want to see kind of what the impact is going to be on your profits or your income statement, it just gives you some additional information, but you just don't want to make capital budgeting decisions based on it. So then that leaves us with the other three techniques, and the other three are referred to as sophisticated capital budgeting techniques. And there's some controversy between the three as to which is better. In academia, we prefer the net present value. We like the net present value for a number of reasons, and this is where I really get into all that when in part 2 of the video on capital budgeting, when we get into the theory. So I'll kind of save the discussion for that. But academia has long favored net present value for a number of reasons. Firms have really favored the internal rate of return for a long time. Now, more recently, and when I say more recently, like in the last 10 years especially, more and more firms have integrated net present value into their capital budgeting spreadsheets. But I do know that, like 25 years ago when I first started doing, or even before that, when I first started doing executive development courses, there was a lot of pushback on net present value. Internal rate of return was definitely the favored capital budgeting technique for many companies. I'm not going to say for all companies, but for many companies, certainly the companies I worked with. And then Profitability Index is also a very good capital budgeting technique to use in conjunction with the net present value. And again, I will talk about that some more when we get into the theory. So with that, I'll conclude part 1. And then in part 2, what we're going to do is we're going to start comparing the net present value and the internal rate of return. We're going to find that the net present value and the internal rate of return, and the reason I'm choosing these two to compare in part 2 is because one is preferred by academia, the other is more preferred by in practice. And what we'll do is we'll find that they consistently offer the same accept-reject decisions. And by accept-reject, I mean if net present value is positive and says that the project is acceptable, then you can be sure that the internal rate of return will be greater than the cost of capital. In other words, they won't conflict in terms of one, NPV saying it's acceptable and IRR says it's not. That won't happen. However, we need to know more than acceptable or should we reject it. A lot of times we need to rank projects. So, you have a capital budget of X amount of dollars and you can't afford to accept all your profitable projects. So you're going to have to rank them. And this is where NPV and IRR can give different decisions. So we're going to talk about that in detail as we get into part 2.